Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Jason Trennert. Jason is the CEO, chairman, and chief investment strategist of Strategas. Jason, how are you doing today?
I'm doing great, Ross. How are you?
Doing really well. Thrilled to have you here to talk markets. And it's a Thursday afternoon that we're recording, so that means we got inflation data this morning. It showed what was expected, which is a deceleration, but still far too high a number for anyone's comfort. So I wanted to ask if you had any big takeaways from this morning's report, and then also ask how that plays into one of your all's broader themes for the year, which is inflation might be heading down, but it's going to remain sticky, and therefore rates will remain sticky as well.
Yeah, I mean, I think it certainly is good news that the headline inflation rate is coming down. I'm not so sure it should be that surprising, just to the extent to which M2 growth, which I follow pretty carefully, has fallen pretty dramatically, and the Fed has clearly tightened. But I think, as you say, Ross, we think there are some structural issues that may make it hard to get inflation down to the Fed's target of 2%. Anytime soon, or at least without any significant economic pain. The Fed still appears like it's in tightening mode, although it wouldn't surprise us if they stopped raising rates sometime here in the first half. That may relieve some pressure on stocks, on the stock market, but generally speaking, I think it's going to continue to be a stock pickers market in which investors favor companies that have the ability to fund themselves as opposed to relying on the kindness of strangers to fund their own growth.
Right, and that's another one of the themes that you all have been highlighting for quite some time, which is a focus on companies that can generate their own cash flow, that can fund themselves and not have to go out to the capital markets. Another theme that I wanted to talk about that you all have highlighted for 2023 is China reopening with a vengeance. So, that could be inflationary. It could also be, a positive for global growth. They're clearly taking the reins off their COVID zero policy. So I'm curious how you evaluate China heading into 2023 and what it might mean for the U.S. domestically.
Yeah, Ross, I can't claim, or I don't know if any of us here at Strategas can claim any sort of great insight into China. They clearly kind of march to their own drummer, and it's also pretty clear that the country is not particularly long on nuance. It's once it makes a decision, it seems to be all the way in, whether that's zero COVID or reopening. I think the reopening carries with it, given some of the challenges I've heard about Chinese medical system, it carries with it probably some issues for supply chains in the short term, just to the extent to which people will get sick. But I think once a kind of herd immunity is established there, it seems pretty likely that they're going to go for it in terms of economic growth. And that in turn will likely put significant pressure on upward pressure on commodity prices. So that is, I think, one of the things that will be perhaps a challenge for the Fed later on this year. You mentioned before, and I didn't answer, and I apologize about the idea that inflation may come down, but interest rates may stay sticky. I think that's one of the reasons why higher rates may stay sticky, is that you're going to have more competition for as far as commodity prices are concerned. I also think there's going to be a lot more issuance of government securities globally, and that's going to be something that even though inflation may be coming down, there may be some sense in which investors require some premium over the rate of inflation to lend even sovereign countries money.
I think that makes a lot of sense. And let's wrap up here. I want to stick abroad because you mentioned some of the reasons that capital might flow out of the U.S. into other countries. We've seen the U.S. dollar come in pretty significantly or fall pretty significantly since its peak sometime in the fall of last year. At the same time, the situation in Europe doesn't look quite as dire as it could have been. China is reopening. What is Strategis's, in your view, on kind of the broad international assets in general as we head forward into 2023? It's an asset class that has really struggled to keep up with U.S. stocks for a long time.
Yeah, it's a great question, and I have to say I'm somewhat conflicted by it. It wouldn't surprise me though, if European stocks did a bit better than U.S. stocks this year, partly just because of the massive valuation differences between the indices there versus our index here. I'd also say that their indices tend to be more value oriented, where ours tend to be more growth oriented, and we have a bias towards value over growth. I wouldn't take that to mean, though, that this could be a long and sustainable change abroad, and that's simply because some of the change, some of the benefits, or some of the positives that you're seeing out of Europe right now are largely dependent upon the weather, or they're dependent upon things that can change very quickly. I'm not so sure that they've made the structural changes needed to outperform on a long-term basis. But having said that, just the fact that China is reopening, and the fact that it does appear as if some of the things that we were worried about with regard to Europe are a little less severe than we thought, it wouldn't surprise me if European stocks did a bit better this year.
Right. Yeah, we don't want to be basing any longer term investment decisions on the weather, but I think all of those other points are very prescient. And Jason, I want to thank you so much for joining us today. It's been really insightful, and hopefully we'll get to talk to you again soon.
Terrific. Thanks a lot. Happy New Year.